Good morning, everyone. This is Todd Blickenstaff, President of American Association of Individual Investors, AAII, the Portland, Oregon Metro chapter. And along with my colleagues, John Wong, our webmaster, and Marlon Wilson, our logistics coordinator. I'd like you to welcome you to our first meeting, general meeting of the new year of 2021. And we're all eager to hopefully have a better year in 2021 than we had in 2020, although the markets didn't do badly. But we're going to defer discussion of that topic to our special guest speaker today, Dr. Marvin Appel, who has a PhD and an MD. He is president of Signal Alert Asset Management. And, again, we saw fast bear market, fast recovery in history in 2021, and Marvin's going to discuss that. And he's going to discuss political parties, which is better for the stock market historically, outlook for the market, the economy, inflation, interest rates, stocks, and high yield bonds, and recommended investment strategies for the new year. Now, Dr. Appel is president of Signal Alert Asset Management in Great Neck, New York, which manages 210 million in client assets in mutual funds, exchange traded funds, and individual stocks and bonds, using technical analysis and active asset allocation strategies. Dr. Appel is also editor of Systems and Forecasts, highly regarded newsletter on technical analysis that his father, Gerald Appel, started clear back in 1973. And Dr. Marvin Appel's books include Higher Returns from Safe Investments, Using Bonds, Stocks, and Options to Generate Lifetime Income, released in 2010, and Investing with Exchange Traded Funds Made Easy, released in 2006. So he's been involved in exchange traded funds since really around their inception. He's also co-wrote Beating the Market 3 Months at a Time. Those books are published by Prentice Hall. And you may have seen him on CNBC, CNN, FN, and CBS Market Watch over the years. And so without any further delay, I'm going to turn the microphone and screen over to Dr. Marvin Appel. And looking forward to your presentation, Dr. Appel. Thank you for joining us this morning.
Thank you very much, Todd. It's a pleasure to be able to speak to the Portland chapter. I only wish it could be in person, but webinars are good too. So it's great to be back again. I had the pleasure of coming in 2019, and
yes. Yeah, May of 2019. Enjoyed your presentation then as well.
Thank you. Yeah, so I'm a money manager and a newsletter writer, and my clients are individual investors who are interested in having a manager who watches their back, and we use technical analysis to do that. But I'm not going to talk about, I'm going to talk a little bit about risk management. When I was here in 2019, I talked about it extensively as it relates to high yield bonds. But today's presentation will be about my outlook and recommendations that you can act on yourselves if you're so inclined for 2021. So which party is better for stocks, some tax projections, and the investment outlook. Well, the good news from an investment point of view is that, well, I should say to start with, the post-election year out of the 4-year presidential cycle has historically been a below average year for stocks. It's still profitable on average historically, but below average. And the good news for us in 2021 is that of the different scenarios, the best historical scenario for post-election years has been when the White House switched from Republican to Democratic. And that's shown in this chart here from Ned Davis Research. That's the highest performance. This is all election cycles from 1900 through 2017. So the only caveat is that, again, this is a historical average. The first couple of months has historically been rough for stocks after the Democrats take over the White House from a Republican. Certainly that was the case in 2009. So we'll see what we have in store for us early in the year, but at least from the point of view of the political alignment, the fact that it's a Democrat taking over from a Republican bodes well for this year. On the other hand, if you break it down further, there are implications potentially of having all Democratic control of the federal government. So on the whole, what's been better for stocks has been Republicans in Congress and Democrats in the White House. The best scenario for an investment point of view, I'm not talking politics, is a Democratic president, or has been a Democratic president with a split Congress. But we don't have that. What instead we have is a Democratic president and a Democratic Congress. So that has happened a third of the time since 1901, and it's not great for stocks. It's not the worst, but it's not great. So we have some, and that's as long as this remains the case. So if we're looking at historical precedent, we say, okay, the fact that a Republican president, that the White House switched from Republican to Democratic, that bodes well for stocks by historical precedent. The fact that it's all Democratic control of Congress for at least the next 2 years does not bode as well for stocks, but still potentially profitable for stocks. So what are the implications? Well, it looks to me and this is not an original sentiment by any means, but it looks to me very likely that we're going to see an increase in income taxes. And Biden in the campaign specifically targeted the long-term capital gains tax rate for high income taxpayers. So in years past, when people had a windfall and sold businesses or stocks or whatever, they bumped themselves into a high tax bracket and paid 20% or whatever the long-term capital gains rate is. Biden is targeting that, at least in his campaign, for people with more than $400,000 in income. So this is something to watch out for. Also look for an increase in federal estate and gift taxes. That's not going to raise a lot of money, but it'll set the tone that we're all in this together. Now, that means in 2021, we might have an opportunity to front run some of these changes. I just spoke with an accountant, and normally, and this includes President Trump's Tax Act in 2017, normally they don't make it retroactive. So there's a chance that they'll enact a new tax law this year that'll take effect starting next year. If they do, that would reverse the usual tax incentives. Normally, when tax laws are stable, the incentive is to delay your gains the following year and realize your losses early. But if the new tax law is not retroactive, and if there's one that passes, which I think is likely, and if it's effective starting in 2022, the incentive is going to be to consider selling your winners now at a lower tax rate and defer your losers until next year when you'd be deducting against a higher tax rate. So we might see by the end of the year the strongest stocks having some temporary selling pressure. And again, all of this depends on whether they make a retroactive tax law or not. So it may be, the result in Georgia was not expected. And so for those who did their tax planning last year, that might be good for them. For those of us who didn't change anything last year, it may be too late or not. We'll know when we see what the tax law is. But it's certainly, once we see that, it's going to be very important this year to review your tax situation, your plans for selling stocks or businesses or property or whatever, and your estate plan and your retirement planning to make sure that you are not vulnerable under any change in the tax law. Now, the economy, to my mind, is the big question mark hanging over the stock market and the bond market. And of course, if you're waiting for GDP figures to come out, that's not timely data. It's only once a quarter, and then it comes out in the middle of the following quarter. But fortunately, there are more timely measures of the economy, and one I like to follow is the New York Federal Reserve Weekly Economic Index, which you can just Google New York Fed Weekly Economic Index and it'll pop up. And that's calibrated to the change in GDP from 52 weeks prior based on data that are reported every week, which the most widely known is the weekly unemployment claims, but also includes things like rail traffic and electricity production and such. And this just shows really almost unprecedented history we've lived through last year. The big drop in the economy basically fell off a cliff in the space of 2 months, GDP falling 12% from a year prior. Compare that to the Great Recession, the financial crisis, which looks positively sedate by comparison. That's the blue line, where it actually unfolded over 6 quarters and at its worst extent saw a GDP contraction of 4%. But notice the recovery. That's why stocks are doing so well. This is probably the briskest economic recovery we've ever seen, certainly since the 1930s. And you compare that to the very gradual recovery that we saw from the financial crisis. So in spite of everything that's going on, the economy still seems to be recovering. Now we may have a hiccup. It looked like there would be a hiccup in December, but we had some last minute increase in some of the data. The employment report for December was poor, with 500,000 jobs lost in the leisure hospitality industry. That resulted in an overall decline of 140 some odd thousand jobs. So the economic recovery, at least for the time being, is stalled, but this is something to watch. The problem for the economy is this, is that it's really not, we're not really living through a widely dispersed recession. It's really focusing on the leisure and hospitality sector, which is about 5% of GDP. So GDP is only about 2% below where it was a year ago. So 5% of GDP has been hit really hard. And that 5% GDP in that sector is 10% of employment. So that's the K-shaped recovery we've seen, is that many areas of the economy, especially for those who can work remotely, and also including manufacturing, are doing well. But those that actually depend on physical customer visits are not doing well. This is data from that Google publishes, the change from baseline in retail and recreation visits. And you can see that, of course, like everything else, fell off a cliff in March and April, recovered fairly briskly until June, and then since has flatlined. So we haven't really seen any recovery in this important part of the labor force. And until conditions are such that it's safe for those of us, for all of us to go back into traveling and eating out and such, the economy kind of has hit a ceiling as far as I can see, and that could pose some risks for the stock market. Now, inflation has broken out. This is a chart of the difference in the yield between 10-year Treasury inflation protected securities and 10-year nominal Treasury notes. So the 10-year nominal note is just closed last week about 1.1%. So if you buy a 10-year TIPS, your return is inflation minus 0.9%. So you're locking in a negative real rate of return. And this 2% projected inflation over the next 10 years is the highest since 2018. So at the depths of the recession, there was very little inflation projected. Now there's a lot of inflation projected. And that could have investment implications. In the near term, the next couple of years, I think that's going to be a favorable factor for stocks, because we know from the Federal Reserve that they are in no hurry to raise rates and that they are ready to tolerate above average or above target inflation for some period of time. So normally rising inflation has been bad for stocks, but the reason is because the Fed steps in and boosts rates and tries to cool things down. This time, the Fed has told us that at least for the next couple of years, they're not going to do that. And so rising inflation is going to mean more sales, more profits, more earning power, and that should help boost stocks and boost high yield bonds. In addition, as I said, the economy is suffering less proportionally than the labor force, because the sectors of the economy that are most hit by the pandemic are high employers, lower wage, lower profit sectors. So the travel leisure sector, a very small part of the stock market, a very small part of corporate profits, very large part of the labor force, and a large part of small businesses. So so what this means is that even the inflation is not going to necessarily take off right away like it did in the 70s, because although there may be shortages of certain things and the Fed has printed a lot of money and all that, there are also going to be plenty of workers available to take on jobs. So wage inflation, at least in the initial phase of the recovery, should be subdued. So I'm not expecting a 1970s inflationary type spiral yet. It depends what the Fed does, but certainly for the next year or two, inflation is going to be a tailwind for investors in risk assets.
Dr. Appel, if I could stop you just for 1 second. I neglected to mention at the start of the meeting that if you have questions at all during the presentation, please enter them in the Q&A section, and then Dr. Appel will respond to the questions later on in the presentation or at the end of the presentation. So feel free to do that if you don't want to forget what your question is. It's great if you could enter them, and then I'm happy to read questions later on during the or after the presentation. Thank you. Go ahead.
Thank you, Todd. Okay, so so far, I mean, the data are mixed, very mixed for the stock market. Here's on the plus side, rising inflation in the absence of a Fed response is good. Post-election year, after a Democrat takes the White House from a Republican, is good. But an all-Democratic federal government has been negative. And another negative factor is valuations. This chart shows price to earnings ratios for the S&P 500. The top bit here is forward. So this is projected price to earnings ratio. And we're at 20. Well, this is for October. We're at 21, highest level since the tech bubble. And of course, that was a bad time to be investing in stocks. If you look at trailing operating earnings, it's the same it's a similar situation. We're at levels that were touched last, at least out of the last 37 years, last touched on a sustained basis in the tech bubble. So valuations are high, and of course, when you're starting to buy stocks at expensive valuations, that means that the future prospective returns are not as good. And indeed, strategists are definitely projecting below average returns for stocks in 2021, well, in the years to come. Here's a sampling. Goldman Sachs projecting 6% a year. Mark Hulbert, based on household stock allocations, projecting just 4% a year. Schwab is the most optimistic at 7.1% a year. Money Manager, GMO, has a forecast of minus 4% a year. So, not blow out the lights numbers. So certainly when we're starting from very high valuations and very low interest rates, there's not a lot of room for improvement, and so stock returns will be modest, perhaps limited to the rate at which earnings grow if interest rates remain stable. And historical earnings growth for the S&P 500 has been about 6% a year over the last, since World War II. So that's consistent with the 6% a year kind of outlook, and that's my own outlook as well. Another factor that's going to weigh on stocks in the near term is that market sentiment is very bullish. There are a lot of measures of that. This is one from the Felder report. This is looking at allocation in the Ridex family of mutual funds to bullish, long equity versus short index funds and cash. And the balance between those two is a measure of sentiment for active traders that use Ridex. And you can see that sentiment, this chart goes back 20 years, the ratio of bullish to bearish bets in the Ridex family of funds is at a 2-decade high. And that's the left chart. The right chart just zones in on the last 3 years. Again, very high levels of optimism have already been priced in to the stock market. Now, good news on the other hand is that interest rates are at historic lows. That's not good news for me as a money manager or for anyone looking for a conservative investment, but it is good news for the stock market. This is the yield on corporate bonds at the lowest investment grade level. And last time we saw interest rates that low in that sector was in the 1950s. If you look, of course, at long-term treasury yields, they touched record lows in 2020. So interest rates are very low. That makes it hard to find bargains in the bond market, but low rates have been good for the stock market. And this chart just shows basically the valuation of the stock market relative to interest rates. So when this graph here in the middle is high, it means stocks are expensive compared to bonds. and when it's low, it means stocks are cheap compared to bonds. And whether you compare interest rates to to the level of forward earnings or to the level of past earnings, stocks are as expensive as they are. Bonds are even more overpriced, and so stocks are a relative bargain. And in those conditions, stock market has been profitable. So it's a mixed bag for the stock market. And what I see in this year is a positive year, but a below average positive year. And I think certainly the next decade, the decade of the 20s, I expect to see much more modest equity returns than we saw in the last decade. And so at this point, Todd, I'll pause and ask if anyone has sent any questions your way yet.
Okay, hang on just a second and let me take a look there. Yes, we do have a few questions for Dr. Appel. The first one is, are Treasury inflation protected securities or TIPS a good buy? I think you briefly referenced them earlier in your presentation.
All right, that's a good question. I think the answer is no. And the reason is because, first of all, they're pricing in a fairly high level of inflation. So I understand that the Fed is going to let inflation. Right now, TIPS are priced to assuming that inflation is going to be 2%, and that's still the Federal Reserve's long-term target. So right now, they're priced. The 10-year TIPS are priced to return 0.9% per year, less than inflation. So even if inflation heats up to 4%, and the Fed, can't do any better, can't control it better than that, your return from a 10-year TIPS is 3.1%. And I think you can do better in other areas of the market, most notably high yield bond funds. So I'm not a great fan of TIPS at a negative real yield.
Okay, and just a follow-up question with that is regarding TIPS is, with a technical term that gets used in the investment world is convexity, and the fact that the interest rate on TIPS are so low. How much does the negative effect of that convexity with volatility in a rising interest rate environment offset the inflation adjustment that you get for TIPS under normal conditions and perhaps today's conditions?
Under normal conditions, TIPS and nominal treasuries have similar levels of volatility. So what really, so I don't think there's, I should preface my remarks by saying I don't have a huge expertise in convexity of different kinds of treasury investments. So the one area where TIPS has a potential advantage is that they never return less than zero. So I guess if interest rates go negative and if interest rates go negative or inflation goes negative, you have some protection in TIPS that you might not have. Of course, going negative is a good thing if you're holding nominal treasuries. So in the rising rate environment, I don't think there's any advantage. Although again, I don't really know it, but I'm not the expert on this. But my observation is that in a normal, stable inflation environment, that TIPS and nominal treasuries should have the similar risk characteristics, and the only difference is whether the embedded inflation projection is changing at the time that the interest rates are changing. So I hope that's as much as I can say about that.
They are complicated beasts. What impact? Speaking of yields, what impact do you believe we'll see on equity dividend yields over the next couple of years?
I think that I believe that companies are going to be committed to maintaining their dividends. So that's the good news. A bigger question could be stock buybacks. That in the last decade, companies borrowed money at very low interest rates to fund stock buybacks. So if interest rates stay low as they are now, I expect that to continue. On the other hand, if interest rates do pop up, which again, I'm not expecting for the next couple of years at least, then that source of cash into the equity market could dry up. So I don't see a big change in dividend policy. I think companies are going to continue to try to grow their dividends as best they can, as best they can. So I'm looking for steady growth in dividend yield in line with earnings growth or cash flow growth.
And you said that you do expect companies to continue stock buybacks despite the fact that the equity market's relatively high priced?
I do. I'm not a big fan of stock buybacks in theory. Yeah, I mean, just in principle, but I'm not aware that companies ever slow their stock buybacks down based on valuations. I think they do it based on whether they have other uses for the cash or I shouldn't say based on, not based on stock prices. Companies will slow down if they don't have the cash flow to fund the stock buyback. And that is a function of interest rates. I don't think it's as much a function of prices being high, because frankly, prices have been high for some time, and the stock buybacks have been continuing. So it's really a function of the economic health of the company. And as with dividends, I expect companies to maintain their stock buybacks to the extent that corporate finance is permitted.
Okay. One of our attendees today asked about the outlook, 2021 outlook for inverse ETFs, and if there will be an opportunity to make any money for inverse ETFs.
Well, if you're good at market timing, then there should be an opportunity. When you expect, or when I project a below average year for stocks, let's say in the 6% range of total return for the S&P 500, that doesn't mean it's just going to drift up at 0.5% a month. It probably means that there'll be a tradable correction at some point. I would not be surprised to see a 10% correction. There's a lot of, first of all, I think a lot of good news has been already priced in, and secondly, I think there's some real dangers from COVID lurking in the shadows. Not to mention the potential dangers that interest rates spike sooner than I expect. So with all the new deficit spending that's coming on, so those are two known risk factors that could rear their heads at any time, and there could be a tradable opportunity. But of course, these inverse ETFs should not be long-term positions. They're only for very very focused short-term bets on a market decline.
Gotcha.
Right now, our equity models are on a buy, so I wouldn't touch it right now. But if there probably will be an opportunity later this year to do some betting on a market correction.
Okay, so just clarify. So your models are positive for equities now?
Correct.
Yeah. Okay.
Yeah, that's something I mean, we update in the newsletter weekly, but our models are still positive.
Okay. Okay. We had a question regarding ties into real estate, and will the work from the home environment due to COVID impact the real estate markets? Will there be opportunities to invest in capital gains? And this particular attendee is particularly interested in the outlook for opportunity zone funds as well. You may not be a real estate expert, but some of this may.
I'm not. I think this is going to have an impact on real estate, and I have to, if I could get on the soapbox for a bit, I think the fact that banks were forced after the financial crisis to maintain higher capital cushions saved us from a world of hurt now, because there's a lot of money in expensive commercial real estate that's in jeopardy. It's focused in certain markets, like New York, where I am, or San Francisco. But I think there are a lot of financial entities that are going to have problems. That I think there's going to be a permanent demand for a permanent decrease in demand for the most expensive commercial real estate. I mean, speaking for myself, my employees, many of them like working from home, and I'm seriously considering making it a permanent feature of my own workplace, even after the pandemic is done, because remote working has been very effective for most of my employees, and in this business, and I know I'm not the only one who feels that way. So it's going to be a tough time for that. I can't speak about opportunity zones. I think. I mean, most real estate really depends on the local climate. there might be an opportunity at some point. Again, this isn't my area of expertise, but you know, a company like Vornado, it's a REIT that has a lot of Manhattan real estate. You know, there might be some bottom fishing opportunity after they take their knocks. So if you're looking for bottom fishing in office REITs, there might be an opportunity there. I always thought it would be nice to own commercial real estate, but I'm as an investment, and right now I'm very glad that I don't. My landlord gave me a break. I mean, it's going to be a tough market for a long time, not just the pandemic, because so many of us realize that we don't need as much office space as we used to have. We don't need the commutes. So I think it's going to be a permanent reset in the real estate market towards lower prices, and you know, eventually, you know, there could be some opportunities there. You have to follow the market and see when you think you pick the bottom.
Thank you. Another question that we received is, historically, we've never had interest rates this low. So in the next 2 years, if interest rates stay this low, what events would cause the market to fall in such a low interest rate environment? As you know, previous market pullbacks have never occurred in this low of interest rate environment because we've never had rates this low.
Right. Well, look, I mean, rates are low. So if rates don't, I mean, rates going up would be the obvious risk, but if rates don't go up, I think the next obvious risk is COVID. The new variants from South Africa and the UK. I mean, the good news is that the existing vaccines seem to protect against them as well. So that's good. That's very good news. But the bad news is that the level of vaccination that we're going to need in this country to get herd immunity, you know, people used to be talking 60 to 70%. Now they're talking 70 to 85%. So, you know, if even 20% of the people refuse to take the vaccine, COVID's going to be with us, you know, with sporadic outbreaks, at least until so many people get infected, that between the vaccine and the natural immunity you get from having been infected, gets us to that herd immunity level. So any kind of bad news with COVID could do it. And I'm frankly surprised that the market has been so indifferent to all the bad news that has been coming down the pike in the last 2 months regarding COVID. What else could do it? Look, people. I mean, I have to laugh because I've been in this business long enough to know that when people start projecting how politics is going to affect the stock market, you know, it's best to take it with a grain of salt. And so plenty of people said, well, if the Democrats win in Georgia, that the market's going to correct 5 to 10%. Well, we haven't seen that. You know, it was more of a relief rally than anything else. So who knows? But you know, maybe the Democrats will push something through that's much worse than what the market expects, and that could lead to something of a reset. You know, trade drama with China has kind of simmered down, but that could always flare up depending on whether the incoming president decides to make trade issues a policy or not. So these are just things that have already caused the market to stumble that could easily come back. You know, who knows? Corporate earnings, you know, with an unfavorable political climate, corporate earnings might take more of a hit than the stock market is projecting. So it's usually the things you don't know, though, that knock you through a loop, not the things that you can foresee. And that's one of the potential advantages of technical analysis, is when you're looking at market data to tell the story rather than news headlines. Sometimes you can still, you know, even if you get the news wrong, you can still get the trend right.
Good point. So this gets a little bit into the political realm, but you know, follow-up COVID question is, do you anticipate with the questions and some of the survey results I've seen for relatively low percentages of people that plan to get the vaccine, very surprising, and given the known side effects and complications, could you see that there could be legislation to either require or encourage people to get the vaccine so that we reach herd immunity at a sooner rather than a later date?
What I could see is vaccine becoming a requirement of employment, for example. So, you know, what if you know, I could see legislation about masks and ultimately maybe vaccination before you're allowed on an airplane. I could see employers requiring vaccine as a condition of coming to work. So I think that way. I don't think the government, again, I'm not a lawyer, but I don't think the government actually requires you to get a vaccine. Uh, they do indirectly. For example, it's illegal to keep your kid out of school, and your kid's not allowed to register for school until they've been vaccinated. So, once they validate the vaccine for younger populations, I could also see them making it a condition for registering for school. So I think through the back door, yes, but will there be a vote in Congress that says, the vaccine police are going to knock on your door, and if you don't have proof you've been vaccinated, you'll be fined or arrested? I don't see that coming.
Okay. And one other question, I guess a follow-up question on the stock buybacks. Do you expect any laws going forward against stock buybacks? You indicate skepticism for them. I share that as well. And with a new administration with different philosophy coming in, if there might be any restrictions, particularly some of these companies getting windfalls or government aid and then using that for stock buybacks. I know there was criticism of that in the previous downturn.
I don't know. I wouldn't put that past an all Democratic federal government. I'm sure there are plenty of people surrounding President-elect Biden who would like to see such a thing, but I believe I don't believe we'll see that, because I don't think the government really can get into that deep in the weeds as how companies spend their money. That they can, maybe they can discourage buybacks with some change in corporate taxes, although I don't think, I mean, corporate tax law doesn't really favor buybacks. I guess it favors buybacks over dividends, but so I think the government would find it hard to micromanage corporate finance, with that much granularity. It's I mean, the government tries to do that all the time. Yes, if a company took PPP money and then engaged in, or some kind of government money and then engaged in stock buybacks, how do you prove that they used the government money for stock buybacks? It's a very complicated issue. I don't think it would be amenable to any workable legislation. So I don't see it, but I'm sure there are plenty of people who want to promote it. But I think as a practical matter, it will be hard to get through.
Okay. Had another question come in that asked about what if the U.S. there's concerns about, the U.S. and fiscal management and, a potential investment grade downgrade at some point. If U.S. debt were to, government debt were to be downgraded, what would be a plausible scenario for making investment changes or emphasis in that kind of environment? Hopefully we won't be there, but
Well, actually, we're already there, right? We lost our AAA rating, and that's a tough thing. We have to see what happens, because I mean, on the one hand, if the U.S. were downgraded and therefore Treasury yields went up, that might make Treasuries a more attractive investment. They'd still be fairly safe, and at the end of the day, the Fed can still print money. So it really depends on the surrounding economic and investment climate at the time. It would be a shame, because it's nice as investors to have some place totally safe to put your money if you don't know what else to do, and a downgrade would put us in that situation where I think investors would be forced into risk assets. So I think it would be bearish. I think, but it really depends on the other backdrop. So when this happened, I think in 2011, it was fine. There was a market correction and there was an opportunity to be in stocks, and so I would say it's the same thing. I'd say there'd be a short-term negative reaction in the stock market, but ultimately it would depend on the fundamental economy. It might be a reason to go into foreign stocks. I'm not a fan of that, but I'll get to that later in my talk. But I'm not a fan of always being in foreign stocks, but that might be the start of an opportunity to buy other developed country stocks. Right now, I don't see such an opportunity.
Okay, just one other question, then we'll let you get to the balance of your presentation. But please continue to put your questions in the Q&A section. I'm sure there'll be a place later on the presentation where Dr. Appel could respond to them. But speaking of corrections, one attendee asked, could you envision a certain percentage pullback for the market if we did have a corporate tax hike? Would that be, would you expect a pullback and have any idea what percentage it might be?
All right. This is, of course, pure speculation. I expect we'd have something. I'm not, obviously, I don't know what percent corporate tax hike is projected. You know, if there was a bump in earnings of about, in after-tax corporate profits of about 7% or so, I think, based on the based on enacting Trump's tax law. So, you know, then 2017 was a good year for stocks, you know, more than 20% gain, 7% gain in earnings. So if you say, if they reverse that and there was a 7% hit to earnings, that might suggest a 7% correction. So I'm not projecting a major bear market, you know, even if they just reversed President Trump's corporate tax cut. I'd expect maybe a 5 to 10% correction based on that level of reduction in after-tax corporate earnings, but I wouldn't think it would be that major.
Okay, appreciate that. Well, Dr. Appel, go ahead and continue with your presentation.
Okay, so now let's shift gears and I'm going to review some strategies that I'm recommending for your consideration in the coming year. One is low volatility stocks. So traditionally, this, by the way, is an ETF called the PowerShares Low Volatility S&P 500 ETF. It's the 100 shares of the S&P 500 with the lowest volatilities. It is very sector unbalanced, you know, a lot of utilities and such. But I just point this out to show that normally, all right, in A, B, and C in this chart, the corrections in low volatility stocks as a group have been shallower than the corrections in the broad index. And in fact, if you had bought this particular ETF when it came out in 2011 and held it until 2019, you actually would have been better off than the S&P 500. Low volatility stocks have a good history, but in 2020 that didn't work out. Because the blue chips defensive stocks of 2020 were the tech mega caps, the ones that thrive by people working at home or working remotely. So 2020 was a year when the relative performance of low volatility stocks as a group really tanked. And I've circled, the bottom line is the ratio between the low volatility ETF SPLV and S&P 500 Spider ETF SPY that tracks the S&P 500 index, and you can see we've had a huge sell-off in relative performance of low volatility stocks. In fact, low volatility stocks had a negative year. This ETF had a negative year in 2020, even though the S&P 500 had a double-digit gain. So if you're looking to play the mean reversion, and I think it's reasonable because I think once the economy returns to normal, originally I was thinking that would be a second half 2021 event. Now I'm thinking a fourth quarter 2021 event where the economy will start to return to normal. People will start to be able to go out and interact face to face and start patronizing retail and travel and such. So if you want to bet on that reversion to the mean, the ETF I recommend for that purpose is USMV. It's another low volatility ETF. And what I like about that one is that it's an optimized portfolio and it doesn't have the same sector distortions relative to the S&P 500 that SPLV does. So SPLV has virtually no tech exposure, but USMV has significant tech exposure. So if you want to play the mean reversion trade and hold an ETF that overall, since its history, has done a good job of matching the market and holding up better during market declines, USMV is a candidate that I suggest for your consideration. Now, more generally, value stocks have done very poorly relative to growth stocks last year. This is the relative difference trailing 1 year gap between growth versus value. And going back to the 70s, and so 2020 basically saw the biggest 12-month trailing gap favoring growth over value that we've seen in 45 years. So again, if you want to play the mean reversion trade, and I don't think it's an unreasonable bet to make, if you think the world is going to trend towards normal, this is an opportunity to either rebalance your portfolios or maybe even overweight value stocks generally. Now, one area that I wanted to spend a little time at, a little time with, is emerging markets. As I said, the data don't support long-term holding of foreign stocks for American investors. You haven't really reduced your risk, you haven't improved your returns. But the data do support the use of foreign equity ETFs on a tactical basis. And I think we're at such a point now with regard to emerging markets. So this chart shows the top part is EEM divided by SPY. It's a ratio. So when that ratio is falling, it means that SPY, S&P 500, is stronger than emerging market stocks. And when it's rising, it means that emerging market stocks are stronger. And you can see that certainly for the last 10 years, the trend has strongly favored American stocks over emerging market stocks. I've circled 3 areas where there was a temporary rally in emerging market stocks that were tradable opportunities. And now we're at the, I'm sorry, two before, 2016, 2017, and now we're at what I think is the start of a third one. And now let me review some history. This is an old this is an old slide, but it shows you since the start of MSCI Emerging Market Index in '88. MSCI US Index behaves like the S&P 500. Over these 28 years, actually the US stocks slightly outperformed emerging market stocks, but look at how different the histories were, right? So emerging market stocks between 2008 and 2016 actually lost money, while of course, US stocks from the peak in 2007 to 2016 gained a lot of money, basically doubled. On the other hand, 88 to 94 was a period of time which was good for US stocks, but emerging market stocks were outstanding. Then when the tech bubble was inflating in the US, emerging market stocks actually had a major bear market, losing 50%. So they have behaved very differently from American stocks. And that suggests the possibility of being able to switch between them, at opportune times. And one simple technical analysis tool you can use to do that is a 10-month moving average of the ratio. So we're looking, in the last chart I looked at EEM divided by SPY, and that's what you would use now to actually implement this in practice if you wanted to. So at the end of every month, you would take EEM divided by SPY, and then you would take the 10-month average of those ratios. And when this month's latest ratio is above its average for the most recent 10 months, then you're in emerging markets. Otherwise, you're in S&P 500. This chart here shows that ratio, emerging markets divided by US. When it's rising, emerging markets are stronger. The red line is that 10-month moving average. And so you can see that, for example, from 94 to 98, there was a strong trend favoring the US. Almost that entire time, the ratio was below its moving average. So if you're following this kind of chart, you would have been in US stocks out of emerging markets for most of that period of time when you should have been. On the rebound, from 2001 to 2007, same situation. Rising ratio means emerging market stocks were generally stronger during this entire multi-year period. And most of that time, not all of it, but most of it, you would have been above the moving average, meaning you would have been in emerging market stocks during most of the time when they were outperforming. Now, of course, nothing is perfect. The problem with this kind of technique is if a strong trend doesn't emerge, you end up switching and then switching back at maybe a less favorable price. So nothing is guaranteed, but this model has worked well. All right, so this slide basically just details how to calculate that 10-month moving average. And I should mention that you're welcome to email me for copies of the slides directly if you like. And I understand that the chapter is going to post the video of this webinar on their website. So I do have, because of the time we spent on questions, I don't have as much time to go over this as I would normally, but it's okay. I'll send you the slides and you can review it at your leisure. Here is how switching back and forth based on that ratio, switching above and below its moving average, would have performed hypothetically on the MSCI indexes. You can see we saw during the first 28 years, both indexes performed about the same, about 10% a year. But switching back and forth, you would have increased your return during this time to 16% a year. So big improvement. Now this is a five-year-old slide. So I've updated the results using the same model, and this is the most recent 5 trades, and 4 out of the 5 were successful, meaning that it picked the area of the world, whether U.S. versus emerging markets, that did in fact outperform during the trade. So right now, actually, we switched on October 31st, 2020, and through the end of the year, emerging markets outperformed, and I believe they're outperforming this year to date as well. So I'm recommending emerging markets now for people who want to remain continuously invested. You would follow the signal monthly to determine when that trend favoring emerging markets would be over. So that's one recommendation for this year. The other one, of course, is consider value stocks, low volatility ETF USMV to play for a bet on a mean reversion as the economy returns to normal. Now let me switch to the bond market. Remember that slide I said about how corporate bond yields were the lowest since the 1950s, but treasury yields are hit record lows last year. So that means that the spreads are relatively attractive. So again, there's no bargain in the bond market, but if you're the kind of person who wants to pick investment grade bonds, investment grade corporate bonds relative to the other opportunities out there are potentially good. From a financial planning point of view, I don't have too many clients who really could be satisfied with the yields that are available from corporate bonds, and any one corporation can go bust. So I'm not a huge fan of buying and holding bonds in this climate at all. But if you're looking to buy and hold bonds, if that's your investment strategy, investment grade corporates are a place to go, as opposed to a more diversified full bond index fund that actually has most of their money in treasuries and mortgage backed. So that's one area that's good. The area that I spoke about when I came out in 2019 was high yield bond fund trading. High yield bonds are not a bargain now, but they're not a ripoff. The spreads now are close to 4% over treasuries. And that's still pretty good by the standards of the last 4 years. So high yield bonds are a good area. As I said back then, they're not good for buying and holding because of the huge risks that can occur. But in 2020, corporate high yield bond mutual funds lost 20% in the space of a month and a half. They've since recovered, but for a bond investment, that's a lot of risk to take. But using the strategy that I talked about in 2019, they would have been great investments and still are. So if you're interested in those slides, if you don't remember it or weren't there when I spoke in 2019, also feel free to shoot me an email, ask me for my 2019 presentation slides, and those slides will teach you how you can manage corporate high yield bond mutual funds and control the risk for your own portfolios. What I like about high yield mutual funds is how much less volatile they are than the stock market. So for 3 months before the election in 2020, we had almost 10% swings in the S&P 500. That's the orange line. Much smaller swings in corporate high yield bonds. Now, corporate high yield bonds right now are yielding about 4%. If you believe in the projection that the stock market might return 6%, you're getting a similar return with a lot less risk with corporate high yield bonds. Next slide shows that for the last 20 years. Actually, over that period of time, high yield bonds slightly outperformed the S&P 500. Obviously, stronger at different times, weaker at different times. But slow and steady can win the race. It certainly was the case for the last 20 years with corporate high yield bonds, and that's without even any risk management. When you do apply risk management, you can way outperform buying and holding. So this is a hypothetical track record for the model we're using to trade corporate high yield bond funds for our clients. It's not exactly the same as the model that I shared with the chapter back in 2019, but the philosophy is similar. I circled the major corrections in the last 17 years that this approach sidestepped, and because of sidestepping it, cut the risk from 35%, worse loss than financial crisis, down to just 6.4%. And by sidestepping those bad periods of time, which is only just a sixth of the time, we're able to completely, completely outperform buy and hold. So this has always been a favorite strategy of mine, risk versus reward, and I don't think this year is going to be any exception, especially if there is some kind of correction coming, where there be a tradable opportunity that could potentially increase returns beyond just the level of yield. So to summarize our current portfolio status for our clients, we are fully invested in corporate high yield bonds and floating rate bond funds. As I mentioned, our equity timing models are on buy signal still, but we are not fully invested in that. We're half invested in exchange traded funds that track the S&P 500 index. We are invested in some balanced mutual funds that they have lower volatility and excellent risk reward characteristics. So we are invested in those. And we are looking to add equity exposure in lower volatility ETFs. Summary for personal finance issues. If you are not able to adhere to your investment plan throughout 2020, given the crazy swings we saw in the market, then you should adopt a safer portfolio. And of course, I can help you with this as a money manager. If you expect to be in a lower tax bracket than normal this year, this is true any year, consider a Roth IRA conversion. Or withdrawing from your accounts beyond the required minimum. Conversely, if you're in a high tax bracket or you don't need the money, of course you want to keep keep as much tax deferred as possible. You should review your estate plan to make sure it will remain appropriate if estate taxes rise or the allowed exemptions fall. And be prepared. Maybe this, if there is a new tax law, which seems very likely, and if it takes effect next year rather than this year, which is a good possibility, be alert to realize capital gains this year and defer losses if that's consistent with your investment strategy. And especially anyone with income above 400,000, should take careful note of that, because we might well lose. Those taxpayers might well lose any advantage from the long-term capital gains rate. Investment outlook: expect continued elevated volatility until the pandemic is better controlled. And again, initially I was hoping that would be maybe the middle of the summer. Now I'm thinking Thanksgiving time, perhaps. There's the historical precedent of switching the White House from Republican to Democratic suggests that we should have a profitable 2021. Albeit with possible turbulence in the first quarter. Economic recovery was very brisk in 2020, but future recovery is going to depend on progress against COVID-19, and that progress has slowed down considerably. Hopefully, we'll get the vaccination rollout up to speed, and that should help things. Stocks are no bargain, and projected future returns are below average, but interest rates are so low that stocks remain viable investments. High yield bond fund trading is attractive and less volatile than the stock market. Momentum currently favors emerging markets over the S&P 500, so you should take that into account in your asset allocation. And low volatility equity ETFs and value ETFs have lagged significantly in 2020, and so they might be potential plays if you want to bet on a mean reversion and an economic recovery. So with that, let me just say that for the video record that I have some disclaimers about this, about the talk that apply to any investment talk. And with that, I'm available to take any additional questions that might have come in. And again, if you want a copy of the slides from this talk or from the one I gave in 2019 about high yield bond fund trading, just email your request to one of my employees, Donna Huber at singular.com, and I'll be happy to send them out to you. Or again, feel free to look at the video from your chapter website. So with that, I thank you very much for getting up early on Saturday to come hear me, and I'm happy to take any additional questions you may have.
Okay, Dr. Appel, what was that? Was Donna Huber? Was that DONNAHUBER at Or was there a T on that?
No, just like you said, no T, DONNAHUBER at Signalert, SIGNALERT.com.
Okay, great. We did have another question come in asking about how do you think the medical insurance and pharmaceutical industries will do over the next few years, given that the Democrats are going to be controlling all three, you know, stages of houses of government.
Well, that's an interesting question because I don't think the health care industry fared all that poorly under Obamacare, and I think there's a lot of political goodwill towards big pharma, given how quickly they developed the vaccine and how how they seem to be resisting the urge to price gouge and such. So I don't see. I don't see a bad scenario for them. I think big pharma is popular enough, and I don't think the government can afford to expand Obamacare in a way that increases the deficit. So I'm not pessimistic about them. I think they're going to continue to do just fine.
Okay, appreciate that. I think before we're done, are there any other questions that that we have? We've answered all the questions in the chat room. I believe. Oh, it seems. Excuse me. There's one other that came in. Okay, actually two more. For your clients, here's one. It seems like the USMV is a trading strategy. Do you recommend value stocks with low volatility that have higher dividends to take advantage of price and of income from dividends for buy and hold investors? Seems like the value trade in small companies, large companies is good right now with the extended valuation of growth stocks.
Yeah, so for people who are buy and hold investors, the very long term, perhaps going back 50 years, the very long term history supports the idea of buying high dividend stocks, especially if you can weed out the ones that are value traps. So if you look at high yielding stocks that have not had a dividend cut, I think that's a very viable strategy, based on the long-term historical record, even though last year such stocks were punished. So for example, dogs of the Dow is a great long-term strategy. And that's one I recommend for buy and hold investors. So yes, I'm more tactical in my investment strategy, but if I were a buy and hold investor, I would be a large cap value investor, and I would invest in high dividend stocks. And I think this is a good time to do it, provided, of course, that you can bear the market risk of buying and holding that share of your portfolio. So yeah, I think it's a great strategy, and I think this is a good time to start doing it, especially since there's going to be a lot of pressure on the Fed to keep interest rates low, either through quantitative easing or through the Fed funds rate. And so if you're looking for investment income, dividends from stocks is really a potentially good way to get a decent level of income and an income level that grows potentially to keep up with or ahead of inflation. Because stock dividends haven't historically kept grown faster than the rate of inflation. So to the extent you can stand the market volatility, I think dividend stock investing is a great strategy.
Okay, thank you. A couple of questions related to the investment management services that you offer. What is your account minimum, and what are the fees that you charge?
Our normal account minimum is $200,000, but I'm flexible about that. Our normal fee is 1%, but if it's an account that trades only bonds, we can discuss a lower fee. 4% of assets annually.
Okay, your bonds. Okay, and then it's let's see. That one question said, Dr. Appel showed hypothetical results. Have the real results been in line with your actual managed portfolios, and how long have you been pursuing these types of investment strategies at your firm?
Okay, well, for high yield bonds, I've been doing this for 24 years now, and my dad was doing it before I joined. So our experience with high yield bonds high yield bond fund trading goes back more than 30 years. And I would say our trading results are in line with the historical results. I will give one caveat is that sometimes when the market's really scary, and that includes the middle of last year, even though ultimately it would have been a great time to buy. Sometimes we take smaller than full positions for clients. So the actual trading, the dates of the buys and the sells, I would say has been consistent with the hypothetical record. But sometimes, if it was a really scary market climate, we took smaller positions, and so we might have been a little less profitable than if we were moving all in or all out based on the signal. The EEM versus SPY trade, that model, as I said, the slide I showed you was originally from 2016, so we have several years of real-time track record on that. I do not manage money for my clients that way because I don't have a good timing model that says when I should be out of both EEM and SPY and in cash only. So I found that in our hands, the results have been better just staying with trading SPY and not trying to get into EEM. But if you're the kind of person who is fully invested in stocks all the time, then this has been a great model, and it has several years of real-time history to validate it.
Okay. One question came in that was about the weakness in the U.S. dollar and concerns over government debt getting too large. How concerned are you about that? And does the movement of the weakness in the U.S. dollar tie into your feeling favorable about emerging markets?
Okay, well, emerging market stocks do better when the dollar is weaker, and although the model just looks at trends, I suspect part of the tailwind for the trend favoring emerging markets is weakness in the dollar. So I think the model already reflects the impact of the weaker dollar, and so I'm not sure how much lower the dollar would go. I am very concerned about the ballooning debt and and what's effectively the debasement of the currency, and I think it could ultimately lead to a very bad outcome for the U.S. Maybe replay of the '70s. I'm not expecting that in the next year or two, but there's only so many times you can get away with stuff like this, and the markets, when interest rates are starting to rise and the dollar is weak, as one commentator I read said, the U.S. is now starting to look like a poorly managed emerging market economy. So I'm very concerned about that, but as in the '70s, I think the best way to navigate that kind of climate is through trading stocks and high yield bonds, trying to avoid the market corrections and then trying to get back in when there's a bounce, because again, the path higher or the path lower is not straight up or down. There are trading opportunities, and I think that it's going to make it hard to be in safe assets. That it's going to be hard to be a long-term investor in investment grade bonds, given the debt, given the debasement in the dollar. At some point, inflation is going to rear its head, and so unfortunately, investors have no choice but to dabble in risky assets. And then the question is, how do you do so while maintaining the risk? So I think that's the best that we're going to be able to do.
And that ties into another question we got for suggestions for preserving your retirement nest egg. And it sounds like what you're saying is, you've got limited enthusiasm for bonds, and there are some risks there, so that you probably need to own at least some equities to preserve your retirement nest egg, particularly on an after inflation basis. Is that correct?
That's correct. I mean, even if you're a bond investor, right? For example, over the many years, an investment in like a total bond market index fund, would have been a very reasonable investment. It's just in recent years, when interest rates have really collapsed, that the prospects are not so good. So, but even investors like that historically would have benefited from a 20% allocation to stocks, because some of the time stocks and bonds move in opposite directions, especially stocks and treasuries, and so all investors should, even conservative investors, should consider at least a 20 to 30% allocation to stocks, and that will help you keep up with inflation, even if it's below average returns. Yeah, you know, to be conservative, again, our approach is trading the corporate high yield and floating rate bond funds. That's been, you know, that risk management has been very successful. It was successful in 2008. It was successful last year. So that's what I do. If you want to be if you want to be in investment grade bonds, I think you know, a very broad based index fund is reasonable. You won't get rich. You might not even keep up with inflation, but your potential losses over a period of years should be modest. So that's still an option. It's just not as attractive an option as it was in decades past.
Okay. And other than the ETFs you mentioned, do you have any other suggested plays for the value reversion play that you expect?
One ETF that I like again as a long-term overweight is consumer staples. The ticker symbol is XLP, and that is one that has held up better than the broad market during most market corrections and declines, and so over its entire history has come close to matching the S&P 500. So risk versus return, I think it's a good ETF. It has lagged this year because there's no technology in it. So I think XLP could be a good long-term holding as well.
Okay, great. Well, I appreciate that. I think that's all the questions that we have today, and really appreciate everyone's time today. Thank you, Dr. Appel, for another excellent presentation. Really appreciate I guess I was muted there for a minute. But I wanted to thank you for the presentation and for answering the questions there. We will have this presentation posted on our website, our chapter AI PDX chapter website within the next week or so. So look for it there as well. And so you can get it there, or through getting a copy to a request from Donna Huber at signalalert.com. And we'll keep everyone posted as to future meetings that we'll be having. We don't have them on the schedule yet, but we'll keep you posted going forward and go from there. So thank you everyone for your participation today on this Saturday, and enjoy the balance of the day. Looks like we're going to get sunshine here in Portland anyway, and hopefully not as much rain. So thank you very much, and we'll looking forward to staying in touch soon.